Hi, this is Jyoti Prakash from PRPH with an update on markets. With, we'll start with the bond market. And last week, it is the United Kingdom's bond market which was center of attraction. There, the yields got inverted 2-year, 10-year for the first time. And also the 10-year GSEC yield on UK bonds rose higher than the US bonds. And that's the first time this has happened this year. And why has this happened? This has happened because of the mini budget presented by the new government and the subsequent turmoil in the bond market as fiscal deficit rose higher to about 8%. Now, what does it and this has implications. The yields going up. Suddenly, UK pension funds were on the verge of getting big margin calls, and therefore that forced the central bank, the Bank of England, to intervene. And we think that's the right thing that the Bank of England did, because if yields go up from 3.1% to 4.6% in matter of 10 days, then the whole you have a financial crisis on hand, and therefore Bank of England stepped in and decided to buy long duration bonds for a specified period. That's still the month of October, and by that time the chancellor uh, should be coming out with fiscal measures that would allay the fears of the bond market. Now, a lot of comparison is being drawn by the current inflation regime to the one that saw witnessed in the 1970s and 80s. But there are two differences here. One is that that was driven by oil prices. This time it is the inflation is fairly broad-based. Second, that time there was no inflation targeting in place. Today, most central banks, including that of India, have inflation targets, and they need to adhere to that. So the tolerance for inflation is lower today than what prevailed in 1970s and 80s. India also had its monetary policy committee meetings. The rate hike was 50 basis points, but the emphasis on global rates going up is significant, and therefore now the expectation is not restricted to a terminal repo rate of 6%. People are now talking about 6.25, 6.5%. And so the next meeting in December, the economists who expect between 35 to 50 basis points of rate hikes. Now, although the JP Morgan inclusion in JP Morgan index is out of calculations now, but still there is some hope, because India has been retained on watch list for FTSE Russell emerging market bonds. So let's see, there's still some hope left. This is a CLSA analysis which draws the difference between the 10-year yield of India and that of the US, and which is at 13-year low. And according to them, this is not sustainable. So either the US yields fall or we go higher. But there are reasons why Indian bonds have been doing well. This is the first time in 20 years that for 12 months running, India's inflation is lower than that of the US. So there are reasons why Indian bonds have been doing well. There is hope that in the US about inflation coming down. The inflation, the 10-year US break-even inflation is now down at 2.19%. It was 3.02% in April. So there is hope there. On the contrary, the inflationary expectations in India has been going up. It's now in double digits as discussed in the latest MPC meeting. So as interest rates go up, the deposits have to go higher. The small savings schemes, the rates have gone up, but not significantly, between 10 to 30 basis points. But the point is, this had also not fallen significantly. Therefore, the rise is also marginal. This is interesting that the share of the PSUs in lending is now at 50% during the last 1 year. There are two reasons I see to this. One is that the lending has been mostly to the MSME sector and not to the corporate sector per se. And the PSUs are good at lending to MSME sector. Second, The credit deposit ratio for PSUs were lower, so they do have that scope to lend higher quantum uh, as credit compared to that of the private banks. But hopefully, their underwriting standards have improved, and they're going forward in 2-3 years. We don't see NPS coming back to haunt the PSUs. Now, it happens rarely that both equities and bonds correct. And so far, the wealth destruction in the US has been $58 trillion, with both bonds and equities coming down. Now, if this is not tightening of financial conditions, then one does not really know. But yes, so far, the backbone of inflation has still not been broken. The investors are shy of investing in equities and in bonds. So what are they doing? They are parking their funds in money market instruments, and that is now at the level of $5 trillion. And this is double of what is the normal. And the similar thing had happened in 2008-9 also. So this money, eventually, when things stabilize, bulk of this money will come into either the bonds market or into equities. The starting point yield for investing in bonds is very important. People often disregard this when the bond prices are falling, but one should not lose sight of the long run. So this graph tells us that eventually, if the bonds price yields begin to decline, and if you're today investing at 7.5% YTM, your eventual return over the next 7 years would be 9%, which is not a bad thing to be in, because that would have far less risk than investing in equities and probably earning marginally higher. Equities, all major indices fell, but India has been a consistent outperformer. And there are reasons why India should be outperforming, and there are reasons why one should be wary about it. Overall, the equity narrative across the world has not been very positive because the geopolitical tensions have been going up, and we really have no clue about what's going to happen related to energy in the European region. There is also this crack in the monetary tightening. UK is going in a different direction, and will Bank of England's decisions to buy bonds impact the ECB or the US? That remains to be seen. But at the same time, with so much of pessimism, the markets are also, having that scope to give positive returns going forward. Here is that comparative chart of 11 top countries in the world in terms of weightage, and India is one of them. This time we are focusing on the two countries which have done very badly. One is China, local currency, and the other is Germany in US dollar terms. Germany faces both the problems: one of high energy costs, second of China slowing down, because it does export a lot of capital goods to China. Coming to India, while the earnings growth for 22 has stabilized around 16.9%, but we are getting into the earnings season as early as next week, and therefore it remains to be seen whether we remain at 16.9% or thereabouts, or move higher or come down. If we are to come down, obviously the markets will get impacted. This is one of the reasons why China has been not been doing well. One is, of course, the zero COVID policy, and as a result of which, Chinese economic output will lag behind the rest of Asia for the first time since 1990. So that's something which is happening not happened in the last 30 years. Now, it all remains to be seen because the markets have corrected big time, but so far the profit estimates, the EPS growth estimates are still fairly strong. So it remains to be seen. And if you're talking about recession, whether the EPS growth estimates for corporate will be as per expectations or will go below. Now, this is an interesting analysis done by HDFC AMC. Will please those who are positive on Indian equities. What it tells us is that while the market is still at 60,000 rupees, the earnings have gone up significantly in the last 1 year, and therefore the P ratio is actually down 27%. And as on 24, in 1 year back, the P multiple was 31. On a trailing basis, now it's come down to 23. But this is the other point of view where it talks about the relative overvaluation of Indian equities. And what we are saying is that earlier the Indian mid caps used to either trade at plus 20 or within a band of plus or minus 20% to the valuation of US mid caps. But today we are at 90% premium. So there is very little margin for error. This is another interesting work done by CLSA. What it is saying is that when the gap between the bond yield and the earnings yield is greater than 2, you have a problem on your hand, and it is possible. And if it is more than 2.5%, it's possible for the next 2 years, equities historically given negative returns. State Bank of India mutual fund has come up with an interesting bit of statistics. It says 50% of SIP from small towns and cities. We all know that the larger cities are well penetrated with regard to financial investing, but look at what SBI Mutual Fund is telling us about the interiors. 33% of retail business is from beyond the 30 largest cities in India. And so that's something we all also know, that the large cities are well penetrated and the opportunity really lies beyond the large cities. Here is a contra indicator. This is a survey of American investors. It's at a level which was worse only during the great financial crisis. So when all people are bearish, markets tend to give positive returns. Yet another indicator that the US equities have corrected quite a bit. They can correct more, but anyone buying equities here eventually will make money. Similarly, when we look at the oversold indicators, we are again back at where the June lows, and from there the markets had rebounded well. We are back there, but let's see, with the dollar being where it is, whether this bottom will hold. Another statistics which tells us that US equities have meaningfully corrected. For technology companies, one does look at price to sales as an indicator for valuations, because many of them are not profit making. And now it's come down from 8.5 times to 4.5 times. This is a better indicator to value technology stocks, which have a long runway and the growth is back-ended. So we are back at levels, at 4.5. Typically, what I've read is a multiple of 6 for price to sales is a good number to deal with. We're at 4.5, again, too much of pessimism. Asset-backed securities have done at par with equities last week. Coming to currency, the oil market is now eagerly waiting for the outcome of the meeting on 5th of October of OPEC+. Russia is putting pressure on OPEC members to cut output by a million barrel a day. But I guess there's elections in the US, and they'll probably wait for that to get over before that's getting implemented. This is another thing which can be positive for markets, is that typically what history is telling us is that whenever dollar is rallied by about 20% plus year on year, it tends to mean revert and it tends to weaken. So if that happens, that's good for risky assets, that's good for emerging markets. India's forex reserves have been falling from a high of $642 billion. We are now at 537. That time it was 12 months cover. Now it's close to 8.5 months of cover. And that's not a nice thing. And it would really be worrying if this number were to get down to somewhere close to $510 billion. Data releases this week, mostly around the Monetary Policy Committee. And there have been some positives about the current account deficit, etc. And the GST collection, as on expected lines, is nearly 1,50,000 crores. Thank you for paying attention. I hope you guys have a wonderful week ahead. See you again next week.